Good morning, folks. Welcome back to our morning call here at Guardia. And today we're talking about Uber's earnings, what they mean, superconductors, which has been almost like this fever dream of the internet blasting my face and all of my fellow internet friend nerds sending me horribly difficult to track Twitter threads from people with anime avatars. It's been a wild ride. So we'll jump into the superconductor thing. But of course, we can't forget kind of the biggest news in the financial world, markets world, that kind of goes above a lot of people's heads while having kind of a deep impact at times, and which is the U.S. downgrade, the U.S. credit downgrade. And I'll start with that because that ties into almost everything else. So, rating agency Fitch downgraded the United States credit rating from AAA to AA plus. That's basically a full notch in the credit rating system. It goes from AAA to D for default, and as you go down the quality rating curve, the yields of bonds tend to get higher. The cost of borrowing, which is it's basically the equivalent thing, the cost of borrowing for the company or country with a low rating is significantly higher, and the risk profile of companies and countries with low ratings is significantly higher, meaning it tells the financial world, if we lend money to this company or if we lend money to this nation, country, state, we have a higher chance of not getting our money back if it's below what's called investment grade, which is typically the B to A range. However, as you get down in the lower quality curve, it gets a little spicier. It gets a little more exciting. There's a lot of money to be made by, making bets on things that you think are labeled to be riskier than they really are. It's incredible. It kind of makes bonds turn into stocks, right? Because if a bond that was issued at a price of 100, is associated with a bad company or a bad country that made some mistakes, it gets severely downgraded. People sell their bonds, and now the bond is trading at 50, and the return, the yield of that bond on the secondary market is enormous. You can come in, buy the bond at 50, collect 20% yield, and then end up actually getting paid at the end of the bond and get paid 100. But that's super boring. US got downgraded. What does it mean? Typically, for most countries, it would mean that their bond yields go up, people sell their bonds, but the world, especially looking at sort of the European market session and the Asian market session, didn't care too much. And it's kind of a complicated thing. There's a lot of pushback on the rating agency's decision. The reason they cut it is mainly because of the United States' unsustainable debt burden. Seems obvious, right? Credit rating for a country, credit rating for a person. If you have an enormous amount of debt, or you've maxed out all your credit cards, that kind of thing, it's pretty normal to see your credit score go down. And if you go apply for a home loan or for a business loan, or et cetera, they're going to look at that. They're going to look at the load you're bearing and your credit rating and say no, or they'll feed you something somewhat predatory that they more or less know you won't be able to repay. So the agency decided to hit the US with that. It's a big deal. I mean, this is not willy-nilly. They don't change ratings month to month, up and down. It's not like a stock price or anything. It's a very intense decision by the rating agencies. Trust them or not. I take everything with a grain of salt. At this point, the three big agencies, which are Fitch, S&P, and Moody's, two of the three have downgraded the U.S. over in the near term. I think S&P was the first, but I can't quite remember when it was. And Moody's, which Warren Buffett owns, has not downgraded the U.S. So we'll continue to see that. Janet Yellen from the Treasury said, we're not. This data is bad. I mean, this decision is predicated on stale data, which I think is a little bit of a cop-out. But looking at it from 1,000 feet, the U.S. debt burden continues. I would I will dare to make the claim that there's a political layer to this too. The fact that there is such a consolidated view, on the Democrat side, we have a Democrat president, administration. There's these enormous policies predicated on public spending. We have the Inflation Reduction Act, and sort of a growing revolving spending door within the government. And I think that plays into Fitch's decision making, because their mainline comment is the fiscal situation is deteriorating. And remember, folks, the US dollar is not backed by gold. It's not backed by anything other than the US taxpayer. So it's a fairly simple decision for international investors to make. And it's, hey, the US is a money machine. Taxpayers work at these big companies. The smaller, medium companies probably pay more in taxes. It's got a really good engine. It's going to always kick money up to the government. I'm happy to lend the government money because they have, the world's strongest economy of taxpayers plugging them. So Fitch making this decision is a little bit of a, stab in some respect, but for now the market's not caring. The economy is strong, the consumer is strong, corporate earnings are relatively strong, and that segues me into Uber. So Uber reported earnings and declared their first operating profit ever, around $300 million. They are a double-digit billion, type business in terms of revenue and scale of the market they encompass, but most investors sold the stock off, and Uber has been one of those major tech companies that I have followed, and have, made a very strong call on it when it was discounted through kind of 2022, and, realized some of that growth. I'd love to see the shift, from sort of pure scaling growth to profitability. And so it's great to see Uber finally, turning a profit and making good on their promise, especially through the last 2 years, to do so. Most people are concerned about the pace of their growth, the profit margins, their strategy to scale out into sort of like parallel sectors in the industry like freight and food delivery, and kind of pointing at that and saying, hey, is this really driving your growth, or is this really just kind of costing you revenue that's not returning, that's not generating extra profit, that's not generating profit, period. So the Uber saga continues. I think it's an interesting company to continue to look at, see how deep this discount goes in the market, see how bad the perception goes. But bottom line, their management team delivered. It's pretty insane. It's a big company, super convenient. We all love to use it. They have powerful branding. I almost, had this thought this morning about how basically Facebook and social media was this Trojan horse, right? Of like free services, free culture, community, etc. And then suddenly, investors want profitability. Game's over. You guys have to pay, X amount for a blue check or X amount to follow this person's content. So they've turned on the monetization engine, and now they're, gonna slowly realize how many people can we retain at what price or with what products for sale. I feel like Uber is sitting there almost waiting. Okay, once we get autonomous vehicles, once we get AI integrated into the fleet, I think that's when this, business begins to make more sense in terms of scalability and margin. They're all over the world. They're unbelievably creative marketers. I admire the company quite a bit. So without further ado, we'll get into the main event of this morning, which is superconductors. And I don't have a terrible amount to say because I'm not a applied physicist or materials expert. But the bottom line is the current conductor of the world in terms of electricity and infrastructure is copper. We've talked about copper before. A lot of people call it Dr. Copper in the financial world because it tends to be an early warning signal for some economic changes on the big picture. And copper is this immensely valuable industrial material because it's used for wiring. It's used for efficient transportation of electricity and energy, especially for consumer and industrial use. Now, there is this element, there is this material that was allegedly created recently and is sort of going viral across social media and Twitter. There are some truly bizarre threads on this stuff. and it's I think it's a material called LK99. Correct me if I'm wrong. I'll correct myself later, but basically it conducts electricity much more efficiently than copper would, like orders of magnitude more efficiently. And so everyone on the internet is sort of freaking out, watching some of these test videos of people proving this, reading some of the papers, going back in time and seeing other papers written on the superconductor material, and people are getting quite excited about what this means, because it could represent a massive breakthrough in the energy world, and sort of how we interact with physics and energy, etc. It could really just explode efficiency. So really exciting stuff. Some of you have asked me, what's an investable way to look at this theme, explore this theme. I think it's tough. I think we'd have to look at some of the kind of chemical companies that are involved in value-added processes for materials and metals and mining. I actually think metal-oriented and energy-oriented companies are interesting as well. I just saw this morning that ExxonMobil is rolling out some pretty big deals to sell people lithium. And that's why we have it in the portfolio. We think they're diversified and they know how to dig into new markets and new parts of the world and innovate. So you can look at companies like that. You can play around with the copper market. Highly not recommended. The most stories of people losing all of their money, in many cases like inheritances, have been in fooling around with commodities and futures contracts on commodities and big bets like that. You can 100x your money, getting the price of copper right in 2 months, but you more than likely will just get completely burned. But those are ways to explore it right now. I mean, if anyone wants to do a deep dive into superconductor-oriented companies, there will probably be a new wave of venture capital, hype-driven startups in that space as well. But I'll share in our Discord in particular, I'll share some of the crazy superconductor Twitter threads and any info I know. I have a great video to share. It does a great job of summing up the situation thus far. But at this point, from my perspective, pseudo-ignoramus on this particular wave of information fury, I kind of think it's like people getting a little excited about some academic papers combined with some kind of garage band weird videos, and then going to that nth degree that we saw also in crypto. Not saying that's what it is. It's just that level of excitement is very funny to see in applied materials. I don't see it too often. But we've had crypto, we have AI, now we got superconductors. We're out here trying to keep up with trends and get trends on your radar, so we can all think collectively about ideas and the future and where value creation is going to be. So stay tuned for more superconductor stuff. You'll see some videos if you're part of the Discord. If you're not, drop a comment in here in the YouTube and we can chit chat and get you in. Take care, guys. Have a great day. I'm wearing my bearish hat also because of the downgrade and because of the sell-off in some of tech and Uber in particular. So in case you guys were wondering, that's the Easter egg for those of you that watched the end of the video, is the why. Take care, guys.